Hey everyone, welcome to The Explainer. Today we're diving straight into a really fascinating company that's sitting right at the crossroads of physical AI and on-demand delivery. We're talking about SERV Robotics, ticker symbol SRSV. Now, just to be clear right up front, the goal here today isn't to tell you what to buy or sell. No way. Instead, we're going to build a comprehensive bottom-up investment scorecard. We're going to unpack their business fundamentals, their cash position, and look at the technical charts to objectively evaluate if SERV is a viable long-term investment. Let's look under the hood.
To do this right, we've broken it down into 5 key pillars. We're looking at business and market trends, leadership and strategy, financials, specifically that cash and burn rate, then analyzing intrinsic value, and finally, we'll wrap up with some Elliott wave analysis.
All right, let's jump right into Pillar 1, business and market trends and how they're scaling autonomous delivery.
So before we even touch the financials, you kind of have to know what SERV actually does, right? And honestly, the most mind-blowing thing here is the sheer velocity of their physical expansion. I mean, demand for delivery is absolutely surging, while labor costs are just going up and up. That's exactly where short-distance, urban sidewalk delivery hits the sweet spot. Get this, in 2025 alone, SERV exploded their fleet of zero-emission electric robots from just 100 units to over 2,000. They're hitting the pavements in more than 20 major cities now. LA, Miami, Dallas, you name it. And these aren't just remote control toys. These robots have hit SAE Level 4 autonomy with a crazy 99.8% delivery completion rate in super complex urban environments. Plus, they're not doing it alone. They're teaming up with heavy hitters like Uber Eats, DoorDash, and White Castle.
And you know what? That totally highlights their multi-vertical ambitions. Because SERV isn't just delivering burgers on the sidewalk anymore. In 2025, they acquired Diligent Robotics, which literally takes their tech off the streets and straight into hospital corridors. This is a massive move. I mean, sure, hospital logistics, they have way longer sales cycles and tons of strict compliance rules, but they also offer potentially much higher gross margins. So we're seeing SERV actively level up from just a single-category food delivery service into a multi-vertical robotics powerhouse.
Now, you might be wondering, how on earth do they protect this business from competitors? Well, they're trying to build what's called a data flywheel. The concept is pretty straightforward, but extremely powerful. Basically, the more deliveries these robots do, the more data they scoop up. That makes their AI models smarter and more accurate, which boosts operational efficiency, which then brings in even more merchants and platforms. But, and this is a big but, it's super important to realize this moat is very much still under construction. The playing field is wide open right now. You've got rivals like Coco Robotics, Neuro, Wing, and even DoorDash's own robot Dot all fighting for space. Plus, giants like Uber and DoorDash are using a multi-vendor strategy right now. They haven't signed exclusive deals with SERV. So for SERV, winning the long game absolutely depends on locking in this network effect over the next couple of years.
Okay, moving on to Pillar 2, evaluating leadership and strategy. Let's see who's building the engine.
You know, evaluating leadership is absolutely make or break for early-stage companies. Execution is literally everything. SERV is spearheaded by co-founder and CEO Ali Kashani. He's been the driving force behind this tech since he incubated it inside Postmates way back in 2017, long before spinning it out of Uber in 2021. The big question is, how does management think about spending their capital? Just look at this quote from Kashani. He says the sidewalk business is the engine, and moving into medical logistics isn't some random pivot. It's just an extension of what they already do. They're just reusing their core capability of getting robots to navigate autonomously through crowds. It's a highly rational long-term approach. They're choosing to prioritize tech R&D and massive scale over making a quick buck today. And honestly, that's exactly the mindset you want to see for long-term compounding, even if it does come with some dilution risks along the way.
That brings us to Pillar 3, financials. Let's talk cash and burn.
All right, so this is where we run into that classic early-stage tech dynamic. Explosive growth happening right alongside massive financial losses. Let's start with the good news first. $260 million. That is the massive war chest of cash and marketable securities SERV is currently sitting on, which got a nice boost from a roughly $100 million raise in October 2025. Now, to put that into perspective, against total assets of $380 million, their total liabilities are just $17 million. Debt is virtually non-existent, literally just $5 million in capital leases. This incredibly low leverage structure, it's a real game changer. It gives them tons of runway to experiment, pump out robots, and run their operations without being bogged down by external debt.
But they are going to need every single penny of that buffer. Take a look at this contrast, because it's stark. For fiscal year 2025, sure, revenue grew a ton to $2.65 million, but their operating loss, $113 million. Free cash flow is deep, deep in the red. And looking ahead to 2026, management is guiding for an almost tenfold revenue jump to $26 million. But their non-GAAP operating expenses are projected to stay astronomically high, around $160 to $170 million. They are going to be burning through cash aggressively for at least the next 2 years. Return on equity, return on invested capital, both are currently negative. So it's safe to say SERV is not exactly a mature, profitable enterprise just yet.
So let's move to Pillar 4, analyzing intrinsic value, or what I like to call pricing for perfection.
So if they're basically a cash-burning machine right now, what is this company actually worth today? Let's break down the math impartially. The stock's been hanging around that $935 to $945 range. Wall Street, they are super bullish. Analysts have targets clustered way up between $16 and $20, mostly pointing to better robot utilization. But if we run a two-stage discounted cash flow model, it tells a slightly more, grounded story. Even if we assume really strong growth, like hitting $200 million in revenue by 2030 with free cash flow reaching $50 million, a conservative model puts the intrinsic value at just $6.53 a share. Even if we use a super optimistic scenario, projecting $80 million in free cash flow by 2030, the intrinsic value only bumps up to about $8 to $9. That is still just shy of where it's trading right now. And obviously, if that growth slows down at all, that value sinks below $5.
The main takeaway here is pretty simple. A $700 million valuation means the market is heavily pricing in future perfection. If you're an investor buying in at these levels, you're paying a massive premium for expected future scale. You're betting that they pull off that data flywheel we talked about perfectly. You're definitely not paying for their current ability to generate cash. It's a pure bet on the future.
All right, that leads us into our final section, Pillar 5, Elliott Wave Technical Analysis. Let's see what the charts are telling us.
So if the fundamentals point to a cash-burning machine with sky-high potential, what is the actual market psychology saying? Well, what's really fascinating here is the crystal clear structure on the weekly chart. Using Elliott wave theory, we can see SERV finish this massive wave 1 impulse. It just rocketed from around $5 all the way up to $17 in early to mid-2025. But after that euphoric run, the stock got hit with a brutal deep wave 2 correction. It retraced something like 70 to 80% of that move, dropping us right back down into this current $8 to $9 pocket. But notice how the volume has actually picked up down here in this bottom zone? That suggests we might actually be seeing a bottom confirmation play out right now. Let's pull up the wave table and see what this might mean for the future. If this wave 2 bottom manages to hold around that $8 to $9 level, Elliott wave theory projects a massive wave 3. Now, wave 3 is typically the strongest, most explosive impulse wave in the cycle. The theoretical target here is pointing all the way up to the $23 to $25 range. That would be a crazy gain of over 150%. Looking at the momentum, the RSI is sitting at 45.34 right now. It's stuck in a declining channel, but if the price actually completes this bottoming process, we'd expect the RSI to start showing some positive divergence to officially confirm the reversal.
But hey, we've got to look at the technical risks neutrally here. That bottom signal, it is not fully locked in yet, mainly because the RSI hasn't dipped into extreme oversold territory, like below 30. The absolutely critical line in the sand to watch is the support level at $7 to $8. If the price breaks down below $7, scratch that, it completely invalidates this entire bullish 5-wave structure. We'd have to tear up the wave count and start all over. Just for reference, what traders are looking for here is a solid weekly bullish candle paired with a big volume spike. That would be the true signal that wave 2 is finally over.
So as we wrap up this explainer, you should walk away with a pretty clear picture of two totally competing realities. On the one hand, SERV Robotics has this incredible technological path. They're scaling like crazy, and they've got a massive pile of cash to fuel their ambitions in a super fast-moving industry. But on the flip side, their competitive moat is still unproven. They are burning through cash at an alarming rate, and the current valuation basically demands flawless execution over the next 5 years. So I'm going to leave you with this one final thought to chew on. With a company standing right at the cutting edge of physical AI, but trading at a premium that essentially prices in perfection, is the market simply way too early, or are they showing up exactly on time?